Hello, everyone. My name is Ron Feldman. I'm Chief Development Officer here at ApplePie Capital, and we're going to spend the next 30 to 45 minutes together talking about the pros and cons of refinancing to grow your franchise network. Took a quick look at the registrations, and it looks like we have people with 1 unit, people with 2 to 5, and people with over 4, and a couple with over 10. So we're going to keep the content kind of broad and try and be relevant for everyone on the call. I did get your pre-registration questions, and I will be addressing them as well at the right time of the presentation. So feel free to ask any questions in terms of that you have. Everyone is on mute, so we don't have any side noise, but there's an attendee chat feature for you. Just type in your questions. If I can answer them in real time, I will, and if not, I will answer them at the end. And last, there is a little on your screen. There's a little emoji thing at the end of the presentation. If you like us, give us a thumbs up. If you didn't, give us a thumbs down. Please give us some feedback, and be happy to talk to anyone after the fact to see if we can help you in general. So with that, we'll get going. Things we're going to cover today: what are the pros and cons of refinancing your business? We're going to discuss the difference between refinancing and recapitalization, but specifically how a recapitalization loan can help you grow. Also, what the qualifications that lenders are looking for, both financial and operational. The questions you should be asking your lender, and how to evaluate your options based on your growth objectives. So those are the 5 topics. And we'll jump right in. So here are the definitions. A refinance is exactly what it sounds like. It's refinancing your debt into a new loan without any increase in the amount of the outstanding debt. So as an example, if you had an SBA loan for $458,000 and you refinanced it, you'd be borrowing $458,000 from the new lender to get out of your SBA loan and get your house back. That's what a refinance looks like. A recapitalization is taking that refinance and adding more debt to that to be used for corporate purposes, open another unit, do remodels, etc. And the last type is a specific type of recapitalization, which is called a dividend recapitalization, and that's used to give cash out to shareholders or pay a dividend or buy partners out or things like that. So those are the 3 terms that we're going to really cover in depth in the presentation. Just wanted to make sure we get clear on the definitions. So what are the benefits of just refinancing? First thing is you could be optimizing your debt for better terms. Sometimes you want a longer term. You have 3 years left and you'd like to have 5, or you have 5 years left and you'd like to have 7 so that your payment would go down. Second one, and this is one we hear all the time, I pledged my house and I don't want to pledge my house anymore because I have an SBA loan, or they took my securities or anything else or even if you don't have an SBA loan, you've had to put up your house for a regular loan. You want to release that collateral. There are lenders that will do that based on the company and your personal guarantee in lieu of taking specific outside collateral. 3 is to free up SBA eligibility. There is a limit on SBA borrowing of $5 million. A lot of the brands that we work with, a lot of the fitness brands, a lot of the child care brands have very high investment sizes, and you can hit that $5 million cap in 2 or 3 units. So you might want to refinance your existing units so that you free up SBA eligibility to borrow to get more units. The 4th one doesn't seem as important now as it did a year ago, but I can tell you one thing that I can guarantee you. If you have a 10-year loan, in the next 10 years, interest rates will go up. I don't know when, but I can guarantee you that they will. Because fixed rates are out there and they're inexpensive now, you can eliminate that risk by getting a fixed rate loan now. And the last one is, I'll give you an example. We had a guy who had 25 haircutting franchises, and he had 25 different SBA loans and was making 25 different payments every month. That's a lot of stuff. That's a lot of moving parts. That's a lot of things that are really unnecessary. You can consolidate all that into one monthly payment. Refinancing pitfalls. You could be getting into a loan covenant situation that you don't currently have. I'm going to talk about them more a little later. Many conventional loans come with prepayment penalties. A prepayment penalty says that if you pay this off before a certain period, you're going to have to give us a percentage of the loan, of the outstanding principal, as a prepayment penalty. You might have to use other, if you've got a loan on your first unit and your second unit's done out of cash and the lender doesn't have a lien on it, and you refinance, you might have to use that second unit to also guarantee the first unit. Personal guarantees, you have them in both, but you're gonna re-up on the personal guarantee. And some lenders have things called prohibitions against future borrowing. Sometimes they carve out a small amount, and it's something you just have to look out for. It's not in every lender's documents. And costs. So you're going to have, if you switch lenders, you're going to have the same landlord issues that you have, and you're going to have to make sure your lease equals the amount, or your remaining lease term equals the amount of what the new loan is. So if you have 5 years left on your lease, the longest loan you're going to get is 5 years. So you might have to go to your landlord and ask for something, and that could be opening Pandora's box. So there are the negative sides of doing a refinance. The positive sides we discussed, but just want you to be aware up front that that's kind of where it is. The reason you do this, obviously, is maybe you'll get a better rate. Right now, if you were in an SBA loan at the highest price when you got it, prime plus 2.75, you're looking at a rate in the high sevens. We're lending right now in the high fives, so you could get a much better rate, and our rates are fixed. Looking at a recapitalization, a lot more sizzle to this one than just a straight refinance. Here you can take the equity you have in your business and use that to grow your business, either for the down payment for a new unit or, quite frankly, for the whole unit. If you have a remodel reimage program coming, it might make sense for you to just recapitalize your business and pay cash out of those remodels instead of taking short-term loans for those things. You can also take out working capital if you need extra working capital. You have a free bite of the pie here, as based on your borrowing power, and we'll talk about that a little later. What is your borrowing power? And lastly, you can do a dividend recapitalization to a point. Sometimes lenders are not conducive to you borrowing money to take it out, but if you're buying out a partner, that's something that happens all the time. One of the questions was, prior to registration, do you do partner buyouts? We love partner buyouts, especially when the operating partner is buying out the silent partner. That's really an ideal situation with the ability to get great terms. Again, if you have questions, just use the chat feature. The pitfalls of recapitalization, many of these are the same. In fact, they're all the same. So I'm not going to go through each one of them individually, but you're signing up for a new loan document with all of these potential issues that you just need to understand. There's no reason to not do it, but you want to read your loan documents. If you don't understand it, you want to make sure that someone who does understand them advises you and lets you know what you can or what you can't do, especially as it relates to future borrowing and covenants. And I'll talk about one specific covenant a little bit later. So what are lenders looking for with your application? That your existing cash flow is strong, at least 1.25 times your debt service. If you want to calculate that, take your monthly payment times 12 times 1.25. If you make that calculation and your cash flow is that amount over your debt service, then you're a good candidate for a refinance or a recapitalization. Liquidity, they want to make sure that you're not doing this because you're running out of money. Your books and records, I can't stress this enough. people tend, and accountants tend, to counsel you on minimizing your tax. So you want to maximize your expenses, especially things like cars and cell phones and kids on the payroll and a few of those other things that we see all the time. Those add backs aren't always acceptable. So you want to make sure you have clean books and records. Obviously, your personal FICO score is important. 700 is kind of the litmus test there. This one's very important too, that your obligations in your report and your income are in alignment with each other. And we see this a lot where people are, they have a high FICO score because they don't miss any payments, but they're not showing the income on their tax returns because they're playing games. You want to make sure that there's alignment there. Obviously, they're looking for positive sales trends and positive expense trends. They don't have to be getting better, but they have to be solid. So you want to make sure if you have positive sales trends and your expense trends are the same, that's fine. But negative sales trends are a big red flag for any lender that's out there. Questions you should be asking your lender. The first one is the covenant I was talking about. It's called the post-distribution covenant. It's in some lenders' documents. The question is, can I take cash out of the business without tripping a loan covenant? If you have a post-distribution covenant in your loan agreement, the answer is you can to a point. If you remember that 1.25 number, it'll drop generally to 1.1. So they're going to limit how much money you can pull out of your business. The difference between 1.1 and 1.25 is what they'll allow you to dividend. That's not your salary, but that's a dividend at the end of the year. Distribution, dividend, whatever you want to call it. Can I borrow money to do maintenance? I'm going to make sure that's clear in your use of proceeds. Can you sign an operating or capital lease for new equipment or vehicles? That prohibition against existing borrowing, might, if you went out and bought a car and put it on the business, or leased a car and put it on the business, you might be tripping that covenant. If I want to open more units, are you in this for just today, or will you lend me more money as long as I'm performing? Of course, you've got to be performing for anybody to lend you more money. So you want to make sure that you ask those questions of us or any lender that you're talking to. We are a capital markets partner. That's how we believe we are. We believe that we can partner with you as a franchisee who's a great operator in your brands, and we have everything from QSR on this call to a couple from the massage brands, fitness brands, healthcare brands, even a hearing aid brand. What would that partners do for you? No franchising first. You want to talk to someone who understands franchising, especially if you're looking to borrow money to grow. If you're just looking to refinance, it's a little different. But you want somebody who understands your brand and specializes in franchising, that can provide you a bunch of options that meet your goals. If you go to your local bank, they're going to give you one option, whatever they have available. If you go to someone like ApplePie or one of our competitors, if they only have, you should ask them, how many products do you have? So we have 5 products that we can offer you, and we're going to let you know everything that you qualify for. You want to have somebody who's focused on your long-term goals. When someone calls ApplePie and wants to talk about financing, the first question we ask is, well, how many units do you want to open? It isn't how do you want to get this one unit done. So there's different products for different stages of growth. And one of the questions I saw from the pre-reg was how to get the best competitive commercial loan rate. First thing is to have great performance, have a great personal balance sheet, and not be growing. If those 3 things are true in this environment, you will get a great rate. If one of those things is not true, you're probably not going to get a great rate, especially if you're growing. Because when you're growing, you have a bunch of startup businesses in your global cash flow. So you want to talk to someone who understands that. And if you are looking for a straight refinance, once you're done growing, that's one story. But if you want to keep adding units, the best rate is not your best friend in most cases, because the best rate is usually the most conservative lender, not the most growth-friendly lender. How should you evaluate your options based on your growth objectives? I kind of jumped on this first, but these are the questions you want to ask yourself. What is your personal financial capacity? If you want to open 20 units and you have 500 grand in the bank, that's not going to happen. You might have to bring on a partner. What is your operational capacity? If you've got 5 units open and you don't yet have a district manager and you want to open 5 more, what is the overhead you need to add to get you to scale? Is there enough territory in your current brand available? Is it close enough? If you're taking, we talked with someone today who opened a second set of units 4 hours away and they're failing, but the home units are doing great. You want to make sure that you're not risking what you have to grow. You want to make sure that you can manage those things operationally. Again, these are operational questions, not financial questions. How are you doing against other franchisees in your own system? How are you benchmarked? A lot of brands offer that benchmarking as part of their analysis. You should, if your brand doesn't, you should ask for it. How am I doing against the other units in my market? How am I doing against other 5-unit franchisees? How am I doing against other 10-unit franchisees? And last is, what is your exit strategy? If you don't have one, you should write one down on a piece of paper. You can always change it. You can change it tomorrow. But you need to kind of think about when this is over, what am I going to be doing? Am I going to be selling the business? Am I going to be giving it to my kids? Am I going to be selling it to my kids? What would happen to the business if something happened to me? You need to ask yourself all those questions. So here are some what-if scenarios. What if you had 4 units open and you were able to do an acquisition and get 4 more, but they didn't come with a district manager? We talked about that a little bit already. What if I built 2 units and opened them within weeks of each other? I do this because I had a Wingstop franchisee in California years ago who planned to open 2 units 6 months apart, but one of them ran into all kinds of permitting and construction delays, and they ended up opening on consecutive Mondays. And it was units 2 and 3, and his infrastructure wasn't built yet. He got through it because he worked his butt off. But what if that happened to you? How would that happen? How would that affect your current operations? What if you were able to get your hands on a few distressed units? That's a great way to grow, by the way. If you know of underperforming franchisees in your system and you can get those units for cents on the dollar, and they're still in great locations and you can negotiate good leases, that's a great way for you to scale your business if they're out there. Some brands are just not out there, but you want to make sure that. But what's going to happen is they're going to take most of your time because you need to work on fixing them. So what would happen to your existing business while you were doing that? The other question you have to ask is, if you're buying businesses that are actually losing money, how's that going to affect my existing cash flow? You got to put that into your pro forma. If it's losing $100 grand a year and you're making $200 grand a year, well, now you're only making $100 grand a year. So until you fix it. Once you fix it, obviously that's a different story. So you got to ask yourself all these questions while you're planning your growth. Excuse me. In terms of products that are out there, we have our own core product. It's probably the best product in the market for growth financing. You can see we got a lot of check marks here. We can use this core product for first-time units in some brands, expansion units in most brands that are partners with us, and we can also use it for projection-based lending. So if you don't have enough equity in your existing business, we can lend based on projections, not based on your existing cash flow. We don't take personal collateral, and we can do multi-unit commitments up front. If you're in SBA, the big differentiator there is that there's really most brands you can get first unit financing in SBA. And they're really good at projection-based lending. The process is very painful to get an SBA loan. Those of you who have gotten them are probably shaking your heads right now, but I can't see your faces because we're on a webinar. But getting an SBA loan really is not fun. But once you have it, there's generally no loan covenants. You get a 10-year loan, and it's a pretty good loan to have. Conventional lenders, again, you get speed. You can get a multi-unit commitment, but that's going to be based solely on your existing cash flow, not on projections. And then equipment finance, and then we would add the remodel reimage to this as another use of proceeds. They're really out there for you to buy a piece of equipment or do a reimage or a remodel on your business. Again, we can do all of this at ApplePie with one application from you, and we really just show you everything you qualify for, give you the pros and cons, and then you decide which way you want to go. This is how we work. We've got 30 lenders in our network. Once we do your scoring and your application is submitted through our platform, we match you with those lenders. One of those will probably be us, and we find you the right capital that you need at the right time. Again, if you're growing, interest rate is less important than if you're not growing. If you're growing, flexibility is the most important thing. Because if you get the best interest rate and you have a prohibition against future borrowing, then you have opportunity loss because the right opportunity comes up and you can't capitalize on it. How does it work for us? You complete a short inquiry. We identify what the options are. Once you have a location, we put you into formal underwriting. We close and fund. It generally takes us a couple of days to get you a loan proposal, about a week to underwrite, and we can close really fast. Depends on how quick you are, and more importantly, how quick your landlords are. But we can close in less than 30 days, and we do that on a regular basis. Here's kind of what happens during that process. We create your loan package, we have the pro and con discussion, and then we go to funding. So that's just a flip side to what you saw in the last slide. I mentioned this borrowing power thing earlier, and we just put a link up on the chat. This is a way for you to figure out what your borrowing power is by entering a couple of numbers into a website. If you look at the right side, you'll see we're looking for what your EBITDA is for the last 6 months. If you don't know what EBITDA is, you need to know what EBITDA is. It's the way every lender manages things. It's the way your business is valued in the market when you go to sell it. Earnings before interest, tax, depreciation, and amortization. It's actually the license plate on my car. I get a lot of chuckles, and I have people pulling up to me at red lights telling me how cool that is because they're geeks like I am. So you see we're looking at the last 6 months. Generally, while you're growing, the last 6 months you have is better than the last 12. So we look at the last 6 months and annualize it for our borrowing power calculation. I don't know of any other lender that'll do that. You enter your current amount of debt. You don't even have to enter your payment, but and it'll calculate what your borrowing power is. So here you see the 150,000 times 2 is 300,000 times 3 is 900,000. So that's what the borrowing power is for this particular example. You'll see what your new borrowing power is and what your new monthly payment would be if you took it all out. That's the payment if you took all 900,000 out. Actually, that's your payment if you took 600,000. So it's the additional capital plus the current debt. Hope that's clear to everyone. Here's just a clearer example of that. You can do this without giving us your name. The one question we'll ask in the beginning is, has your business been cash flow positive for the last 6 months? If the answer is no, you probably shouldn't be growing yet. Doesn't mean you can't grow, but you shouldn't be growing yet. We still want to talk to you because if you're on the right trend, we can work with that. So the only thing ApplePie Capital does is franchising. We don't do anything else. We are a growth lender, as I said earlier. We are not a transactional lender. We want to find out what your game plan is. If you go on our website, there's videos of a couple of franchisees that have been with us, that we took them from 1 to 10, 1 to 30. Sometimes it's done with acquisition. Sometimes it's done with development. We understand franchising. We understand how to do it quickly, and we can give you multiple options and get you a higher probability of getting a yes. Once you get a yes, then it's time to look at the terms, but you got to get a yes first. You are all probably really great at running your business and developing new units, but you're not a lending specialist. So if you're a lending specialist, we're really not good at running units and developing new units, but we're really good at lending. So, when you have a broken arm, you don't go to a cardiologist, and when you have chest pain, you don't go to an orthopod. You want to make sure you're going to the right place and make sure that it's somebody who understands franchising, understands your industry, and understands your brand. With that, I got through it in 30. I said 30 to 45, 31 minutes actually. I'd like to open it up for any other questions. One question I saw was rates for refi right now. The message starts, the rates start in the mid fives for us. For AA credits, we're a risk-based lender, and that's for existing cash flow loans. If we're doing a loan based on projection, it's generally 1 point higher than that, or 100 basis points higher than that. But we're happy to discuss it with you and get you a quote. One question: will this webinar be available? We are recording it, and we will send it out to everyone. Are there any other questions? I don't see any more. I'll give you a minute for more questions. This is great. Everyone that signed up stayed on for the most part. It means I didn't put you to sleep. I'm happy. We'll wait about 20 more seconds. Okay then. Thank you all. Please fill out the social media little emojis and let us know how we did as you log off. Oh, we got a question. Hold on. Just popped up. In valuing a partner buyout, what multiple are you comfortable with? Depends on the industry, depends on the size. I hate answering questions with it depends. But in a good brand with 500,000 of EBITDA, 5 times. If it's less than 500,000, probably 4. Hope that answers your question. My email just went up there. If you have any questions, you can shoot me an email directly. And with that, I think we're going to call it a wrap. Thank you all very much and have a great day.